Stop scrolling for just a moment. What I am about to share could be the key difference between watching a massive opportunity sail by and being perfectly positioned to catch it. A seasoned market analyst has just released a silver prediction so bold, so aggressive, that most people will just laugh it off. But that quick dismissal, that simple act of brushing it off, could become the most expensive financial mistake you make this decade. This isn't coming from some random influencer on social media chasing views and clicks. This call is from Michael Oliver, a true Wall Street veteran who's been deeply analyzing markets since the mid-1970s. This is a man who built his reputation by calling major market turning points, often long before anyone else saw them coming. We're talking about the 1987 stock market crash. He saw it. He also successfully predicted silver's powerful surge back in 2025 and the corrective pullback that followed in early 2026. His track record is built on precision and foresight. And now, he's forecasting something that makes those previous calls look small. According to Oliver's highly refined momentum models, silver isn't just poised for a little bump. He believes it has the explosive potential to reach a staggering $300 to $500 per ounce within this current market cycle. And he thinks it could happen much sooner than most people would ever dare to imagine. Now, before you roll your eyes and click away, let's take a serious look at the data behind his conviction. Oliver doesn't rely on gut feelings or hype. His analysis is rooted in a specific methodology he's perfected over decades, momentum structural analysis. Unlike traditional technical analysis that focuses solely on price charts, Oliver's method tracks the momentum behind price movements. Think of it like this. Price tells you where an asset has been, but momentum tells you where the real power is building up and where it has likely headed next. It's about measuring the engine, not just looking at the car's paint job. So what is his model showing right now? For years, silver's momentum has been coiling, building up energy like a spring being compressed. While the price has been relatively range-bound, frustrating many investors, the underlying momentum has been building a massive base. According to Oliver, this multi-year consolidation phase is about to end. He sees a major structural breakout in momentum that will precede a historic breakout in price. This isn't just another rally. He describes it as a phase transition, a fundamental shift in the market's character. What are the catalysts driving this? First, there's the overwhelming industrial demand. Silver is absolutely essential for green technologies. Solar panels, electric vehicles, 5G networks, they all need silver, and demand is growing exponentially. Unlike gold, a significant portion of silver is consumed in these industrial processes, meaning it's used up and gone, not just stored in a vault. This creates a constant, inelastic demand that's tightening supply. Second, there's the monetary aspect. With global debt levels at all-time highs and central banks printing money at an unprecedented rate, the search for real, tangible assets is intensifying. Investors are growing wary of fiat currencies that can be devalued overnight. Silver, like gold, has been a store of value for thousands of years. As confidence in the current financial system wavers, a flight to hard assets is not just possible. It's probable. Oliver believes we are on the cusp of a major currency crisis, and when that happens, silver won't just be a good investment, it will be a financial lifeboat. Let's combine these factors. You have soaring industrial demand colliding with shrinking available supply. Then, you layer on top of that a potential global rush into hard assets as a safe haven from currency devaluation. This creates a perfect storm for a parabolic price explosion. Oliver's models suggest that once silver decisively breaks its previous all-time highs, there's very little resistance to stop it. The move from $50 to $100 could happen incredibly fast. And from there, the momentum could carry it to $300, $400, or even $500. Think about the implications of that. If Oliver is even partially right, the wealth creation could be life-changing. Now, this isn't a guarantee, and all investing carries risk. But when a veteran with a proven track record of calling major market shifts makes a prediction this big, it pays to listen. The mainstream will ignore it. They'll call it crazy. But the biggest opportunities are often found where the crowd isn't looking. This could be one of them. Do your own research, but don't dismiss this call lightly. The cost of being wrong is small, but the cost of missing out could be enormous. Have you ever wished you could see a market crash coming before it happens? Or spot a massive rally just as it's about to take off? Well, there's a guy who has a knack for doing just that, and his name is Michael Oliver. Today, we're diving deep into who he is and why his work is so crucial, especially right now. So, who is Michael Oliver? Back in 1992, he founded a firm called Momentum Structural Analysis. At first, he was mainly working with big institutional clients, the kind of people who manage billions of dollars. But what makes him stand out isn't who he works with, but how he sees the market. Most analysts you see on TV or read online are obsessed with price. They draw lines on charts, look at moving averages, and try to predict where the price will go next. This is what we call traditional technical analysis. They are essentially reacting to what the price has already done. Michael Oliver does something completely different. He believes that focusing only on price is like watching the waves on the ocean's surface without understanding the powerful currents underneath. He developed a proprietary method where he converts price data into what he calls momentum structures. Think of it this way. Imagine a volcano. Before it erupts, there's immense pressure building up deep within the earth. You can't see it, but the energy is there, getting stronger and stronger. Oliver's analysis is designed to detect the hidden pressure in the market. He's not just looking at the price, he's studying the energy, the momentum, the force that will eventually cause the price to make a huge move. While everyone else is watching the price, he's measuring the energy behind it. Now, you might be thinking, now that sounds interesting, but does it actually work? Well, let's look at his track record. This isn't just theory, it's a methodology that has been tested by some of the biggest market events in recent history. Remember the infamous 1987 stock market crash, known as Black Monday? It came seemingly out of nowhere for most people. But Oliver's momentum work signaled that a major breakdown was imminent. He saw the underlying structure of the market weakening long before the final collapse. Fast forward to the incredible rally in silver. In 2025, while many were skeptical, his analysis identified the immense momentum building up, pointing to an explosive move higher. He wasn't just guessing. He was reading the energy that was about to be unleashed. And it's not just about calling the big moves up. He also called the major market correction in January of 2026. While the consensus was still bullish, his momentum structures were screaming that the market was exhausted and ready for a significant downturn. These aren't just a few lucky calls. This is a consistent pattern of recognition, honed over decades of experience. It's about seeing what others miss because they're looking in the wrong place. They're focused on the symptom, which is price, while he's focused on the cause, which is momentum. So why does this matter to you and me? Because in today's incredibly volatile markets, understanding the underlying energy is more important than ever. We're living in a time of unprecedented economic and geopolitical shifts. Relying on old models that just look at price can be incredibly dangerous. Oliver's work provides a framework for understanding the true health of a market. It helps cut through the daily noise and the talking heads on TV. It gives you a sense of whether a trend is strong and likely to continue, or if it's running on fumes and about to reverse. It's about making more informed decisions, whether you're an investor, a trader, or just someone trying to protect their savings. Knowing when big shifts are likely to happen can be the difference between preserving your wealth and suffering devastating losses. In a world full of opinions, Michael Oliver's work is based on a measurable, repeatable process. He's not telling you what he thinks will happen. He's showing you what his momentum analysis is revealing. It's a different way of looking at the world, and in financial markets, having a unique and effective perspective is priceless. That's the power of momentum structural analysis. It's not about predicting the future with a crystal ball. It's about understanding the present forces at play so deeply that you can anticipate their most likely outcome. And that's why Michael Oliver's work continues to be so relevant and vital for anyone navigating these turbulent financial waters. Thanks for watching. If you found this explanation helpful and want to learn more about unique approaches to the market, ever wondered if silver could hit a whopping $300 to $500 an ounce? It sounds wild, but let's break down the logic behind this bold prediction. This isn't just a random number someone pulled from a hat. It's based on some serious market analysis and historical patterns. First, let's talk about the silver to gold ratio. Think of it as a way to measure silver's price relative to gold's price. In early 2024, silver was trading at about 1% of the price of gold. So if gold was at $2,000, silver would be around $20. But by the spring of 2025, that ratio had already doubled to 2%. Now, 2% might not sound like a huge deal, but in the world of financial ratios, that's a massive structural shift. It tells us that silver is starting to gain ground on gold, and fast. To put this into perspective, let's look at history. Back in 1980, during a major commodities bull market, the silver to gold ratio peaked near 6.5%. More recently, during the 2011 price surge, it hit about 3%. These historical peaks show us what's possible when market conditions are right. Now, let's do a little math. Many analysts are looking at gold's potential in this current cycle. Based on how gold has behaved in previous bull markets, some believe a move toward $8,000 an ounce is on the table. It's a high target for sure, but let's use it as a hypothetical for a moment. If gold did reach $8,000 and the silver to gold ratio simply returned to its 2011 level of 3%, what would that mean for silver? Well, 3% of $8,000 is $240. That's a huge jump from where we are today. But what if we get a repeat of the 1980 mania? If the ratio climbed towards 6% with gold at $8,000, you'd be looking at silver prices near $480 an ounce. This is exactly how we get to that incredible $300 to $500 projection. It's not about wishful thinking. It's about applying historical ratios to potential future gold prices. The key ingredients are a strong bull market for gold and a return of the silver to gold ratio to its historical highs. Of course, this journey won't be a straight line up. Markets are famous for what traders call shakeouts. A shakeout is a sharp, sudden price drop designed to scare nervous investors into selling. Imagine silver starts climbing steadily, maybe to $40, then $50. Everyone gets excited. Then, out of nowhere, the price plummets back to $35 in a matter of days. This is the shakeout. It's designed to make you doubt your strategy, to make you think the rally is over. The big players, the institutional investors, often use these moments to buy up assets from panicked retail sellers at a discount before the next major leg up. The purpose of a shakeout is to get rid of the weekday weak hands, the speculators who are just in it for a quick profit. The long-term investors, the ones who understand the fundamental story, see these dips as buying opportunities. They know that in a true bull market, these pullbacks are temporary. So if you see a sudden, scary drop in the price of silver, ask yourself, has anything fundamentally changed? Or is this just a classic shakeout designed to test my conviction? So there you have it. The case for $300 to $500 silver is built on two key ideas: a significant shift in the silver to gold ratio, returning it to historical peaks, and the understanding that the path to get there will be volatile, likely filled with shakeouts designed to test investors' nerve. It's a fascinating scenario to consider, and it highlights just how much potential could be stored in this precious metal. Thanks for watching. If you found this breakdown interesting, make sure to hit that like button and subscribe for more deep dives into the financial markets. Let me know your thoughts on silver's future in the comments below. Ever wonder why markets suddenly tank right before they explode higher? It's not random chaos. There's a theory for this, and it's called the shakeout. Let's break down what this means, especially for something like silver. Picture this. The market is cruising along nicely, everyone's feeling good, and then bam, a sudden sharp drop. Panic sets in. People start selling, thinking the party's over. These sellers are often called weak hands. They're newer to the market or get spooked easily by volatility. Now, who's on the other side of those trades, buying up everything that's being sold in a panic? These are the strong hands. We're talking about large institutions, experienced investors, the big players. They see these dips not as a crisis, but as a golden opportunity. Think about it from their perspective. If you want to buy a massive amount of silver, you can't just place a huge order without driving the price way up on yourself. You need a lot of sellers to provide what's called liquidity. And what creates a flood of sellers faster than anything else? Fear. A sharp correction, a shakeout, creates that fear. It scares the weak hands into selling, which provides the liquidity the big players need to build their large positions at better prices, set the market, clear out the nervous money, and allow the strong hands to load up before the next major leg up. The psychology here is fascinating. When a market reclaims its previous highs after a shakeout, something flips. The very same investors who sold in a panic at the bottom start to feel a sense of regret, of missing out. As the price climbs higher and higher, that feeling turns into a desperate need to get back in before it's too late. This is called chasing the market, and when those panicked sellers turn into eager buyers, they add a massive amount of fuel to the fire. This is how a steady uptrend can turn into a parabolic, almost vertical move. The very people who sold low are now forced to buy high, pushing the price even higher for the strong hands who bought the dip. It's crucial to remember that markets rarely, if ever, move in a straight line. They move in waves, in cycles of fear and greed. They take 2 steps forward, 1 step back. Or sometimes it feels more like a violent staircase, a sharp move up, a gut-wrenching drop, and then an even bigger surge higher. So when you see a big pullback in a market you believe in, the key question isn't just, will it go down more? The real question to ask yourself is this a sign of real structural weakness, or is this a strategic reset? Is the long-term story broken, or is the market just shaking out the weak hands before the next big move? Understanding the shakeout theory can completely change how you view market volatility. Instead of seeing every dip as a reason to panic, you can start to see it as a potential opportunity. It helps you zoom out, look at the bigger picture, and differentiate between market noise and a genuine change in trend. Of course, no theory is a crystal ball. It's a framework for understanding market behavior. But by recognizing the patterns of a shakeout, you can be better prepared to navigate the psychological roller coaster of investing and maybe even position yourself on the side of the strong hands. It's all about staying informed, having a plan, and not letting fear dictate your decisions. Have you ever wondered what really drives the price of silver? It's not just about what traders are doing day to day. There are huge, powerful forces at play. And today, we're going to break down the 4 biggest structural drivers that support a very bullish long-term case for silver. Stick around, because the last one might just be the most explosive. First up, let's talk about supply and industrial demand. Silver isn't just a shiny metal we lock away in a vault. It's an absolutely critical component in some of the world's fastest growing industries. Think about it. Solar panels, the electronics in your pocket, advanced medical technology, and even crucial defense applications all rely on silver. It's one of the most conductive metals on the planet, and there's no easy substitute. The problem is, production growth has been struggling to keep pace with this surging demand. You can't just flip a switch and open a new silver mine. It takes years, sometimes a decade. This fundamental imbalance between rapidly growing demand and constrained supply creates a powerful long-term upward pressure on the price. It's simple economics, and the trend is clear. The second major driver is something we all feel every time we go to the grocery store: currency devaluation. When we measure silver's price in dollars or any other currency, we have to consider the fact that the money supply is constantly expanding. Central banks are printing more and more, which erodes the purchasing power of each dollar over time. So when you see the price of silver going up, sometimes it's not that silver is becoming drastically more valuable overnight. It's often that the currency you're using to buy it is simply losing its value. Over the long haul, as this trend continues, the nominal price of hard assets like silver naturally has to adjust higher just to keep up. It's a hedge, a way to protect your wealth from being quietly inflated away. Third, we need to look at the bond market. This might seem disconnected, but it's a huge signal. When you see weakness in long-dated government bonds like 20 or 30-year treasuries, it can be a canary in the coal mine. It signals stress in sovereign debt markets and a potential crisis of confidence in government as ability to pay back its debts. During these times of uncertainty, where does smart money go? Historically, it rotates toward hard assets. Why? Because gold and silver don't have counterparty risk. A physical ounce of silver is an ounce of silver, no matter what happens to a bank, a corporation, or even a government. When trust in the traditional financial system begins to weaken, the intrinsic value of tangible assets shines brightest. Finally, we have the Shanghai factor. This is a game changer. For years, many analysts have argued that the silver price has been artificially suppressed by massive amounts of paper trading, specifically naked short positions. These are bets that the price will go down, made without actually owning the underlying silver. Recently, the Shanghai Futures Exchange, a major player in the global metals market, announced new restrictions. They are clamping down on these naked silver shorts, requiring approved hedging quotas. This is huge. By limiting the ability of speculators to create artificial paper supply out of thin air, it could dramatically reduce the downward pressure on the price. Now, think about what happens next. If these speculative shorts are forced to buy back their positions to close them out, that creates a wave of buying. This new buying pushes prices higher. Higher prices put even more pressure on the remaining short sellers, forcing them to cover as well. This is the exact mechanism that creates a short squeeze. With physical demand already strong from industry and investment, and now a potential reduction in paper manipulation, the conditions could be ripe for a significant price acceleration. We could be looking at a scenario where the true fundamental value of silver is finally allowed to assert itself. So, to recap, we have skyrocketing industrial demand meeting a tight supply, steady currency devaluation making hard assets more attractive, potential cracks in the bond market pushing capital towards safety, and a major exchange cracking down on paper manipulation. When you put all these pieces together, the long-term picture for silver looks incredibly compelling. Heard the wild predictions about silver hitting $500 an ounce? It sounds crazy, right? But what if it's not? Before you dismiss it, let's break down what's really happening in the silver market and how you can think like a pro, not an emotional trader. First, let's talk about those nerve-wracking price dips. When silver's price falls, panic can set in. But smart investors don't just see red and sell, they look for clues. One key indicator is the silver to gold ratio. Is silver holding its own against gold, or is it falling behind? If silver maintains relative strength during a pullback, that's often a bullish sign. It suggests the dip is just a temporary breather in a larger uptrend. Another thing to watch is physical premiums. Are coin and bar dealers charging a lot more over the spot price when the market dips? High premiums during a price drop can signal that physical demand is soaring. People are buying the dip and supply is getting tight. This isn't a sign of weakness. It's a sign of underlying strength. Then there are the lease rates. This is a bit more technical, but it's basically the cost for large institutions to borrow silver. If these rates spike, it means it's getting expensive and difficult to get your hands on physical metal. This is a classic indicator of a supply squeeze, suggesting that the paper price might not reflect the real-world scarcity of silver. So when you see a price drop, don't just react. Ask yourself, is silver holding up against gold? Are premiums on physical metal high? Are lease rates climbing? If the answers are yes, you might be looking at a healthy correction, not a market breakdown. It's a chance to accumulate, not to panic. Now for the reality check. Could silver actually reach $300 or $500 an ounce? If it does, it won't be a smooth, straight line up. Let's be crystal clear. Silver is one of the most volatile commodities on the planet. Its history is filled with massive price swings, both up and down. Any journey to triple-digit silver would almost certainly include sharp, gut-wrenching corrections along the way. We could see 20% or even 30% drops in a matter of days or weeks. If you're not prepared for that kind of volatility, the silver market will chew you up and spit you out. It's not for the faint of heart. So when you hear these bold predictions, remember that no one has a crystal ball. Even the most experienced analysts with decades of experience can get it wrong. The future is uncertain. But when someone with a 50-year track record points to a convergence of powerful signals, structural, macroeconomic, and ratio indicators all flashing green, it's worth paying attention. This isn't about blind belief. You shouldn't just take someone's word for it and bet the farm. But you also shouldn't dismiss it out of hand just because it sounds extreme. It deserves thoughtful consideration and your own research. Let's zoom out and look at the bigger picture. We are living in a truly historic era. Global debt levels are at all-time highs. Governments and central banks have engaged in unprecedented money printing and expansive monetary policies. We're seeing major geopolitical realignments, with power dynamics shifting around the world. And the whispers about de-dollarization, countries moving away from the US dollar as the world's reserve currency, are getting louder and louder. In past periods of history that looked similar to today, times of high debt, currency debasement, and geopolitical uncertainty, precious metals like gold and silver have always played a crucial role. Sometimes they act as an anchor of stability, preserving wealth when other assets are collapsing. Other times, they become vehicles for dramatic, explosive upside moves. The patterns are there if you look. The current setup shares some eerie similarities with the late 1970s, just before silver went on its legendary run. Back then, we had high inflation, geopolitical turmoil, and a loss of faith in fiat currencies. Sound familiar? We're not saying history will repeat exactly, but it often rhymes. Ignoring these parallels would be a mistake. So, what if the prediction of $500 silver is too optimistic? What if it only goes to $200 an ounce? For many investors who got in at today's prices, that would still be a life-changing, transformative return on their investment. That's nearly a tenfold increase from current levels. Even a fraction of that move would be a huge win. The real question isn't whether the number sounds extreme or unbelievable. The real question is, what are you going to do about it? Are you going to ignore the signs and dismiss the possibility entirely? Are you going to do your own homework, dig into the data, and understand the arguments for yourself? Or are you going to prepare for the possibility that something historic, something truly massive, is building just beneath the surface of the market? Ultimately, the choice is yours. Whatever you decide, make sure it's a decision grounded in research, logic, and a clear-headed assessment of the risks and rewards, not in fear, greed, or emotion. The financial landscape is shifting, and those who are prepared may find themselves on the right side of history. Stay sharp, do your own due diligence, and make informed decisions. Thanks for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the markets. We'll see you in the next video.